Risk and return. Any decision we take in our life is have a risk and return. So let's start our journey today in comparing between the risk and return and get the main concepts and calculate the risk and if we have an only one item or one decisions or we have different types of investments. So what are the types of risk if we are going to look for one investment or we have a different portfolio of different types of investment, we need to assess the risk and return. This is our journey today. So the risk is the measure of uncertainty, vulnerability, undetermined, ambiguity. So the more the uncertain, the higher the return, as we listen in many terminology. So the return is the total gain or loss. It can be within a certain period of time. It can be calculated by dividing the asset cash during a period plus the change of the value, if the beginning of the period of the value. So the risk, it is the vulnerability, the volatility. It is usually highly reflected to the return. So the return is the difference between what we sacrifice today and what we will get in the future. So it is the difference between the actual and the expected. So the importance of risk, it is to assess it and take a good financial decision and to relate it to the future. So because the expected return will generate more money, so the expected risk is high, so it will be having a high return. Therefore, the risk and return are considered two important concepts in finance and investment. So let's assess first how we can calculate the return, how it is the expected return. So to give it the actual or expected return, it is calculated by the capital gain. So the word here, it is called the capital gain. What is the gain that we are going to have? So in this terminology, we're going to compare between the asset price in the time one and what will be the price in time two. So it will be, let's say if I have an asset which is $2 and before it was $1, and then I can calculate it by 2 minus 1, so I gain within this asset $1 in comparison to each initial investment. But what is the CT? The CT, it is called the capital gain or the cash flow or the dividends. So if I have a car and the car was 2K and I was having it by 1K and now it is 2K, so I gain 1K. And the capital gain, it is the cash over streams of money that I'm receiving during a certain time. So what is T and T minus 1? So if we are in year 2021, so this is T. So what is T minus 1? Then it will be the year 2020. So this is the difference. So let's give an example to understand the meanings of the return or the expected return that we can calculate it from a given certain information. So if we have a 1,000 share of IBM, we purchase it by $20 and now the price has become 21. So it's clear right now that we will receive one extra dollar from these each share of IBM stock. So we look for the dividends, which is the capital gain. So total return here, it will be the $1 that I have it with respect to the $1 with respect to the total amount of numbers of shares. In addition to the capital gain, which is the 2. So the 2 times the 1,000 plus 1,021 minus 20. This is the total return that we have. So, or it is the 3,000 with respect to 20,000, then the expected return, it is 15. So again, if I'm going to use the formula that we have just received, so I have just the $2 dividends, and in comparison to the assets that I bought it is plus 1. And all of this with respect to what? It will be respected to the 20. If I did that, I can find it, and times 100, then it will be the 15% the same way. So the dividends, it is the capital gain, and this the operating gain, and this is the capital gain from the values of the assets. Let's see another example to reflect on the capital gain. So I have here at the beginning of the year, Apple stock was worth $90. And this is an important concept here. If you look for Apple, the share is 90.75 per share, and the Walmart, it is 55.33. So this is P1, the original price. Later, we will see that the Walmart will receive a dividends 1.09 and Apple will pay no dividends. So there is no operating that is going to be received. At the end, you will see that the Apple stock value it reached $210.73, while Walmart increased incrementally just nothing. It decreased in value. Instead of 55, it is 52. So if you go for Apple, there is no dividend, there is no operation that I receive it, but the value of the assets because the company kept a lot of time, didn't distribute the dividends because they took the profit they received in reinvesting in the innovation and developing the products. And the original price was 90.75. So I compare the PT minus PP minus PT minus 1 over the PT, then it will be 132. So it is not usually correct that when we divide dividend, this will be reflecting on the company performance or the company is going great. While in Walmart, they distribute $1 per $1.09 per share, and the value of the stock here, unfortunately, it is decreases. So unfortunately, we find that the value has been dropped, and the expected return it is not positive; it is negative. Does not mean that they lose, but the value of the assets itself has been declining. So this is simply how we can calculate the return for certain assets. So let's go for the risk. We have different types of risk as we're going to explore credit, country, liquidity, interest, market, change rate, and operation. And we go for the credit risk, which means the default. I will not be able to pay back the money that I took it, which means that the company itself failed to meet its obligation or to serve the debt. So the higher the credit risk, the higher the required return for lending. We have a lot of companies that an institution that they are an agency that they are assessing the performance of the company. I mean, from them there are Standards and Poor, Moody's and Fitch, where they evaluate the credit risk of the thousands of corporate issuers and municipalities on the ongoing basis. So the country risk as well, it is given to the political risk or the fluctuation in the exchange rate, the economic risk, and the sovereignty of the country, or the transfer of money if I don't have a limitation to transfer money. And all these types of risks will reflect on the foreign direct investment, where people are afraid to invest and to make a huge machines or buying machines and equipment or do direct investment. The third is the liquidity risk. Liquidity risk refers to the multiple dimension failure to raise the fund at a normal cost. This is will reflect on the market liquidity and assets liquidity as well. The cost of fund depend on the company credit rating. If the credit rating here means if they are listing at A or B or C, this is called the credit rating. And this is the assessment as if I'm giving you a grade. So I'm giving an assessment of the trust in the company. The higher the value it will reach it to the A, the lower the highest the risk. Interest rate means that if I have a high inflation in the country, the interest rate risk can occur due to the movement of interest rate. Anyone who borrow is subject to the interest rate risk. The borrower paying at a variable rate pair at a higher cost when interest rate increases. So this is reflect as well on the cost of in doing any investment. The last one here, which is the market risk, which is the risk experienced due to the unexpected and adverse change or shocks or crisis. And here, such as in equity prices and commodity prices where they drop, where we here compare between the standard deviation that exists in the market. So foreign exchange rate as well, it is one of the criteria that we need to look if the currency is stable or there is a huge variability, there is a link between the asset and liability management with the multi-currency or not. So we have some country currencies are stable while other are not. Finally, operational risk, which is the risk that directed to the failure due to the system, the people, the employee. So this is reflect on the losses of the company. So after we explore the different types of risk, we go for the risk of a single asset, how we can calculate the risk and compare it with the return. So let's summarize what we're going to do in the following slides. First, it is the expected value of return. It is the average return of an investment to produce over time. So I have to calculate the R dash, which is the expected. And it can have also in terms of probability. So instead of doing the mean or the average, you're going to multiply the expected return, taking into consideration the probability of the occurrence and the numbers of the outcomes as we're going to see. So we want to compare the expected return in addition to compare it with the standard deviation, which is the most common statistical indicator. So what is the standard deviation or the expected deviation? It is the sum of the difference between the actual and the expected return all squared times the probability. So let's start our journey in calculating the risk and return. So we will have one asset analysis, and then we are going to look for a time series, and then we are going to look for the probability of the incidence. So if I have an example here where he is giving data in the terms of time series, so I'm going to do the following step. What I'm going to start by looking for this observation, and this observation is called the time series, which is completely different than one item. So the time series here, it is from 1 year to 2 years, sequences of time. And here, this is an old data, which is an actual data that we have. Okay, so we need to do the first step. What is the first step? Is to calculate the expected return. What is my expected return? So I will add the total actual data, 10 plus 9 plus 11, 30, divided by 3. This is give me the mean, which is going to help me when I'm going to calculate the second step, which is my standard deviation. And my standard deviation is looking for the differences between the actual minus the expected all square, but don't forget because it is time series and minus 1. So here I found that the standard deviation of this of my observation is either deviating 1% higher or 1% lower, and this is the standard deviation that we receive it here. So it is just 1%, and this is the 10%. So I want to compare. So in order to compare, you have to compare with other items. So we need to compare with another type of stock to say which is better and which is not better, or we can compare it with a portfolio and compare it with another portfolio. And we will see this later in the coming slide. So let's see as well here, I have a probability, and this probability of one incident. So the previous one was a time series, but here just the probability of incidence of one observation, certain observation, one shot, one observation. Perfect. So if you look for this observation, very bad, bad, fail, good, very good. So this is our 5 probabilities of this observation, of certain observation that is expected. And I have here the probability, as I mentioned before, and this is the expected return for each incidence in the best case or average case or the worst case. So this is what reminds us with the previous point that we explained it. We have to multiply the probability times the expected return, and then we do the sum for each one of them. So let's start our journey. We will start by doing the following steps. So the first step, it is to do what? It is to multiply, is to do multiplication of the probability times what? Times the return. And then after I did that, I have to go for the differences. But here, don't forget that after you did all the expected rate of return, which is the sum of all the observation, which is the 0.174. So I sum all of them together, all of them, and then this is will give me the expected return. So this is the first step. The second step is that I'm going to compare between the actual minus the expected return that I have just calculated, all squared times the probability. So this is will give me the summation of all the values here. So these summations, it is the variance here. So if I took the square root of these variance, this is give me the standard deviation, which means that 20% of variance. I will deviate by 20% higher or lower in each one of them. So expected return was 17.4, and the risk of this stock is 20%. So how can I comment on this is good or bad? So we need to have another type of stock. So let's have another type of stock for, let's say, stock Y with a different probability and return. And I will do the same step, but don't forget, we are going to do first, we are going to do the expected return, which is the return times the probability of these observation. And then we do the sum of all of them, and this is will give me 0.0174. So this is the first step. The second step, which is the standard deviation, which is dependent on the following step. Calculate the difference, doing a square, and then all the square times the probability. When we add all of them, this is will give me the summations of the variance. So what it is request later, it is to do the standard deviation for my calculation. So I calculate the return here, it is 1.74 when I multiply times 100, and the risk of the stock, which is 13.36%. So the standard deviation, it will be 13.36. So which one is better and which one is not good? So to compare, so we put the two stocks in comparison. Expected return 17.4, the Y it is 1.74, the risk is 20%, and the Y is 13.36. So if I have to have the rules to make a judgment, and I will see that these rules are not going to be applied here, because if we have the same return, we have two stock when they have the same return, 10%, 10%, we usually choose the lower risk. Where is the lower risk? It is the lower risk, it's point A or stock A. So I prefer A. But if I don't have the same return and I have the same risk, so for sure, if I have the same risk, I can select the highest return. I can select the highest return. But in our case, we don't have any of these, no same return, no same risk. So the solution is in the what we call it coefficient of variation. So which is comparing the risk to the expected return. I'm comparing the uncertainty to the expected return. And this is depend on the given data. I will use them, and then I will divide the risk will divided by the expected return. We will select the stock with the lower coefficient of variation concerning its return, and this is will be very clear when we do the division, the 20% of the standard deviation over the expected return. And here it's very clear that the stock X, it is higher in it is lower in coefficient of variation. So the lower the coefficient of variation, the better. So I will choose stock X. Great, we did it. But I can use also the Sharpe ratio, but it depends on the requirement. If it is the Sharpe ratio, what they are doing, Sharpe ratio is doing a very interesting, do the opposite. So I will do that instead of doing here, as we explained in the coefficient of variation, I will take the risk over the expected return. I will do the opposite. I will take the return over the I will take the return over the risk. Excellent. The return over the risk, the return over the risk, and then I will choose the hard one. The return 15%, and the risk is here. It is 3% in this problem. Then it will give me 5, and the return here it is 20%, and the risk is 5. Then it give me 4. So the higher, the better. Brilliant. So let's assess our understanding. If you have an example, and the following information of the two copiers, A and B, and we need to do the following step. So I invest in machine A 10,000 and machine B 10,000, and I have a probability here. So I don't have time series, it's just a probability. So I'm going to calculate the expected return by, first I multiply the expected return 11% times 0.3, and then plus 18% times 0.45, plus 22% plus 0.25, and then I will aggregate all of them, and this is will give me the expected return. I will do the same for project B, and then I can make a comment on each one of them. So this is the computation of the expected return. Second, to calculate the standard deviation of each copier. So to calculate the standard deviation, we use the expected return in order to calculate the standard deviation. Then let's see what we can do. So I did this and I prepared the answers. So I multiply the first the expected return for the copier A, and then the expected return or the expected value for copier B. So how I find this, I multiply the return times the probability, and then it's give me these values. Then I sum them, then it will give me the expected value, which is 16.9. Perfect. So this is the expected return, 16.9 for copier A, and the expected return for copier B is 17.5. So we need to calculate the variance and then the standard deviation. What is my variance? My variance is the probability times the difference square. So what is the difference? Actual data it is given here, and it is the expected. So 11 minus 16.9 all square, 18 minus 16.9 all square, 22 minus 16.9 all square times the probability, don't forget. Then this is give me the variance. So the variance in the copier A, it is 17.49, and in copier B, I calculate the variance, it will be 35.65. So I take the square root, and then it is 4.18 and 5.97. So none of them have the same expected return or have the same expected variance. So the final answer, we will take it by using coefficient of variation. So the coefficient of variation is doing what? This 4.18 divided the expected return, it give me 0.25. I would do the same for B, it is 0.35. So the lower the coefficient of variation, the better, which is 0.25. So by this, we did all the assessment for the risk and return. But we need to take care that when we depend on only one asset is not safe. So as we explained in the cost of capital, diversification to minimize the risk. So we need to do a portfolio, and the portfolio is consists of different types of returns and different types of assets. So the main objective of the portfolio is diversify the risk, not to increase the return. I want to diversify the risk to minimize the uncertainty. So this is here, it raised the issue of the correlation between the types of asset that we're going to use it, statistically measure the relation between the two different types, and look for the move of these stocks, if they're going to move together positively or negatively. So what is the meaning of positively or negatively? So positively, that we see that they are growing by time or dropping by time. If I have two types of stock with the same industry, so they are working together, steel and cement together, for example, let's say anything related to technology and devices of technology or network, so they are positively correlated with each other. This is what we call it positive correlated, which is the relation between the return and time, while the negative correlation, when we have two different types of stock, I buy stocks, let's say for an Apple, and another stocks in another industry, let's say for example an automotive industry, so they are negatively correlated. So in order to have the relations or calculate the expected returns and the stocks and take a final decision, so it is important to look for the weight of these stocks. So here, if I have a stock X and Y and 17.4 and 1.74, and I need to find which one is better, and to assess the expected return, to find the values of the expected return, and as well to find the value of the standard deviation. So here, I need to know the weight, and this is what we understood in the cost of capital, the weights of each stock from my budget or from my assets or from the investment that I have it, and then the weighted average of the return, that is expected return. So let's see here. So I calculate the weighted average, which is the 17.4 times 50 and 1.74 times 50. This will give me the weighted average of return. If I want to look for the risk, it will be the same, looking for the weights and taking the risk. So the previous slide, it is the expected return, and this one, it is the risk. So 20 times 50, 13.36 times 50. This is will give me the weighted of the risk. So it is 16.68, and then the weighted return. So how can I calculate? As we see in the table, the weighted average risk is 16.8 without taking into consideration any correlation. But if I have been given the correlation, and this can be used by Excel or can be defined, here the correlations between both of the X and Y is 0.35. So how can I find my formula of risk of portfolio? So it is similarly to the one that we did it before, which is the weight of the stock A all squared times the standard deviation all squared, plus the B all squared times the standard deviation B all squared, plus 2 the weight of A and B standard deviation, and don't forget the correlation between A and B. This is what give me the correlation, taking in consideration the correlation to calculate the risk, which is 13.83. So by this, we finish the risk and return, which you understand the example, and thank you for watching.